Hello friends, welcome back to the channel. Here is the situation. The United States of America has a fiscal deficit of around 6% of its GDP. For those of you who are not fully familiar with what fiscal deficit means, I will explain it in a moment. But just to put that number of 6% in perspective, I will give you another comparative value. India, which is often criticized for its fiscal management, maintains a fiscal deficit of about 4.4% of GDP. Generally speaking, most countries aim for 3% of GDP, which we can call a benchmark. So the US deficit of 6% is much higher than India's and almost double than the benchmark. And yet, the US dollar is the strongest, most trusted currency in the world. Every central bank on the planet holds dollar in its reserves. All global trade, whether it is oil, gold or goods, is settled primarily in US dollars. The US dollar has remained the world's go-to currency for decades now. So the question is this: how does a country that is spending far more than it earns manage to run the world's most powerful currency? This is exactly what we are going to understand today. So let's begin. To understand why the dollar is king today, we have to go back in time. In the past, currencies had value because they were backed by something valuable, mostly gold. If you held a currency note, it was essentially a promise from your government that you could walk into a bank and exchange that note for an equivalent amount of gold. This system was called the gold standard. It gave people confidence. You knew that the paper in your hand was not just paper, it was actually gold. This system of currency notes being an equivalent of gold worked reasonably well for a long time, but it also had limitations. Because your economy could only grow as fast as you can make your gold reserves to grow. You could not just print money to spend on hospitals, roads or armies. If you did not have more gold, you could not have more money. As simple as that. Then the two world wars happened. Countries needed to spend enormous amount of money to fight these wars. They started spending far beyond what their gold reserves could support. This is where the gold standard based system began to crack. By the time World War II was ending, most of Europe was financially destroyed. Their economies were in ruins. They had borrowed heavily and depleted their gold reserves. The only country that came out of the Second World War in a position of economic strength was the United States of America. In 1944, the US held approximately 2/3 of the world's gold reserves. 2/3, 67%. Think about it. So the world need to do something about this situation after the World War II. In 1944, representatives from 44 countries gathered in a small town in United States called Bretton Woods. The purpose was to design a new international monetary system for the post-war era. The agreement they reached was this: every country's currency would be pegged to the US dollar, and the US dollar itself would be pegged to gold at a fixed rate of $35 per ounce of gold. All currencies became indirectly backed by gold through the US dollar. This made complete sense at that time. The US had the most of the world's gold. It had the largest economy. It was the only country at that time capable of guaranteeing that kind of stability. So the world essentially said to the US, "We trust you. We will link our currencies to yours." This was the moment. I'm talking about the year 1944, when the US dollar became the world's reserve currency. This was the official beginning of the dollar dominance. It all went well till 1960s, when the US decided to fight the Vietnam War, which ended only in 1971. The US spent heavily in the Vietnam War. At that time, the US was also spending too much on domestic social programs and was also making all kind of huge government expenditures. These extravagant spendings was done by printing dollars like crazy. And this was a problem that made European countries uncomfortable. Especially France started getting very suspicious of this thing in the US. France had maintained its dollar reserves and they wanted to test whether the US actually had the gold to back all those dollars that they had printed. France started sending ships to the United States demanding gold in exchange for their dollars. Literally. President Richard Nixon realized that the US did not have enough gold to honor all the dollar obligations it had made to the world. So on 15th of August 1971, President Nixon went on television and made an announcement. He suspended the convertibility of US dollar into gold. Just like that, the link between the dollar and the gold was cut. From that day, the US dollar became a fiat currency. In other words, the dollar now had value simply because the US government declared it had value, not because it was backed by gold or any other physical asset. And with that, every other currency in the world also became a fiat currency because they were all pegged to the US dollars, and the dollar was now backed by nothing tangible. Now you might be wondering, if the dollar is backed by nothing, why does the entire world still use it and trust it? The answer lies in what happened next. After 1971, there was a genuine concern in global markets. If the dollar is not backed by gold anymore, why should we trust it? The dollar could have easily collapsed. But again, US played the situation very cleverly. In the early 1970s, the US Secretary of State Henry Kissinger struck a deal with Saudi Arabia, which was the most powerful member of OPEC at that time. The deal was essentially this: Saudi Arabia and OPEC would price and sell all crude oil exclusively in US dollars. Means all crude oil will now be sold in US dollars only. In return to this favor, US would provide military protection and weapons to Saudi Arabia. Like gold, crude oil is also one of the most important commodity in the world. Every country needs it. In an industrialized world, almost everything is dependent on crude oil. Every economy runs on it. If you want to buy oil, whether you are in India, Japan, China, Germany, anywhere, you will first need US dollars. So every country in the world now had a permanent, ongoing need for US dollar. This is what is called the Petrodollar System. The demand for dollars became a necessity. Earlier, country used to keep US dollar reserves because it was pegged to gold. Now people keep US dollars because they would need it to buy crude oil. In a way, we can say that earlier US dollar was pegged to gold, and now its value is underpinned by the petrodollar system. The petrodollar system is one main reason why the dollar remained king even after losing its gold backing. Gold was replaced not by another metal, but by the crude oil. And this is why even today, when India buys crude oil from the Middle East, we pay in US dollars. Even though we are buying from an Arab country, the transaction happens in US dollars. This is the big reason why our Indian rupee and our economy are so sensitive to what happens with the US dollar. If US dollar becomes strong, for some reason, it reflects to us as Indian rupee becoming weaker. Now let us understand another important reason why the US dollar has stayed dominant. It is something called the network effect. Think of it like this. Why do most people in India use WhatsApp? Not because WhatsApp is necessarily the best messaging app in the world, but because everyone else is on WhatsApp. If you want to communicate with your family, your colleagues, your clients, they are all on WhatsApp. But so you have no choice but to be on WhatsApp too, right? The more people use it, the more valuable it becomes and the harder it is to replace. The dollar works exactly the same way. Basically, all international contracts are written in dollars. Oil is priced in dollars, gold is priced in dollars, central bank reserves are kept in dollars, international borrowings are done in dollars. When emerging countries borrow money from international market, is mostly done in US dollars. So you can see the entire financial infrastructure of the world has been built around the US dollar over the last 80 plus years. To shift away from the dollar, you would need every country, every bank, every commodity market, every financial contract in the world to agree to switch to something else at the same time, which you can say at the moment is kind of practically impossible. So the dollar remains dominant not just because of the US economic strength, but because replacing it would require rebuilding the entire global financial system from scratch. And that is what I call the network effect working in favor of US dollars. And here is one more thing. The US also has the world's most liquid financial markets. I am talking about the US Treasury bond market and the US stock market. When there is a fear or uncertainty anywhere in the world, global investors flee to safety. And that safety in the global financial world means US dollar and US Treasury bonds. Even during a crisis caused by the US itself, like the 2008 financial crisis or the current US-Iran war, the dollar actually gets strengthened. Why? Because scared investors around the world bought more dollars. This is a remarkable situation, and it tells you just how deep the dollar dominance goes. I think petrodollar and network effect in combination keeps the US dollar so strong. If I have to estimate what is the weighted effect of these two factors in keeping the US dollar strong, I will give petrodollar 35% weight and network effect 65%. Now that we have understood what keeps the dollar strong, we also need to understand a bit of basics about the concept of fiscal deficit. We know that the US has a fiscal deficit of about 6% of GDP. What does that actually mean? Simply put, fiscal deficit means the government is spending more than it earns. The government earns money through taxes. If the government tax revenue is say 100 rupees but it is spending 106 rupees, then the deficit is 6 rupees. That 6 rupee gap, the shortfall, is the fiscal deficit. For India, the net tax revenue to expenditure ratio is approximately 56%. For the US, the net tax revenue to expenditure ratio is approximately 70%. Now, India's fiscal deficit is valued at about 4.4% of GDP. If India tries to push it higher than that, following chain of things would start to happen. Rating agencies will start downgrading India's credit rating, our currency will weaken, and the foreign investors would start pulling out money from India. India do not have that luxury of keeping its fiscal deficit inflated. We have to keep it relatively low. But the US runs a deficit of 6% and the world seems not to care about it at all. Why? There are few reasons. First, as we discussed, the entire world needs dollars. So when the US issues bonds, which is how it borrows money to cover its deficit, there is always a global queue of buyers ready to buy those bonds. Japan, China, India, European central banks, everyone holds US Treasury bonds as part of their foreign exchange reserves. The demand for US debt is genuinely global. That means the US can borrow whenever they want and almost at negligible interest rates. Why? Because there are always buyers for US bonds. Second, the US borrows in its own currency. Most countries, when they borrow internationally, have to borrow in US dollars. They are essentially borrowing in a currency they do not control. If the US dollar strengthens, their debt burden increases automatically. But the US can borrow in their own currency. Do you know what is the advantage? US can print more dollars whenever they want. This gives the US a unique, almost like an unfair advantage. Third, the US economy, despite its deficits, is still the largest and the most productive in the world. It has extraordinary institutions, deep capital markets, rule of law, and history of honoring its debt. People have been trusting US since many years now. But I think this trust is now getting eroded really fast due to people like Donald Trump running US as if it is his personal company. But for now, the US system is still holding and there is no alternative. So till now we have discussed about the US dollar's dominance irrespective of its high fiscal deficit. Now I will try to connect all of this with our investments. And to do that, we will have to start with government bonds first. When a government needs to borrow money to cover its fiscal deficit, it does not go to a bank the way you and me would. Instead, it issues bonds. In the US, these are called treasury bonds, and in India, they are called government securities or GSECs. The government is considered the safest possible borrower. Why? Because in theory, a government can always print money to repay its debt and will never default. Hence, the interest rate paid on government bonds is considered the baseline safe return. In financial theory, we call this the risk-free rate. This is a very important concept. The risk-free rate is the minimum return that any rational investor will accept. If I can earn say 7% risk-free by simply buying a government bond, then why would I put my money in a riskier investment like stocks or mutual funds? I will buy a riskier investment only when the investment offers me more than 7%. Without this extra return, it would not make sense to take extra risk. So the risk-free rate decides the expected returns from all other investment vehicles of the world. And because US Treasury bonds are considered the gold standard of safe investments globally, the US 10-year Treasury yield is watched by every investor, every fund manager, every central bank in the world. When the US bond yield moves, everything moves. Before the pandemic days, the US 10-year treasury bond yield used to be at 1.3% levels. Now it is around 4.3% levels. Note the almost 3.5x jump in the US 10-year treasury yield since the pandemic. So in a rising interest rate environment, bond yield goes up. As the US treasury bond yields are the risk-free rate for the entire world, when that rises, it has enormous consequences, which we will discuss now. When the risk-free rate goes up, it affects the stock market as well. How? This is the connection that every equity investor must understand. Let us understand what happens to the stock market when the bond yield rises. There is a concept in finance called equity risk premium. When you invest in equities, direct stocks or equity mutual funds, you are taking a risk. What is the risk? The economy might slow down, the company might underperform, the stock price might fall. You are not guaranteed any return. It means you are taking a risk when you are investing your money. So rational investors will only put money in stocks if it offers a high return than the risk-free rate. The extra return you demand from equities over and above the risk-free rate is called the equity risk premium. The formula is simple. Equity risk premium equals to expected return from equities minus the risk-free rate. Now let us think about what happens when the risk-free rate, the yield of the government bond, rises. Suppose earlier bond yield was 4% and equities were expected to return 10%. In this case, the equity risk premium was 6%. Now suppose the bond yield rises to 7%. For equities to still offer the same 6% premium, they would now need to return 13%. But if the economy is slowing down, companies are not going to suddenly start earning 13% or more. So one of the following things will happen. Either the investors will accept the lower risk premium, or the stock price falls to a point where the expected return becomes higher enough to justify the risk. In most cases, stock prices fall as the bond yields rises. And this is exactly why when the US Federal Reserve raises interest rates, stock markets both in the US and across the world tends to fall. Every 0.25% change in the bond yield in the US affects the stock market all over the world. But you might say, I do not even track what is happening in the US bond yield. So I do not do buying or selling of stocks by looking at those yields. So how the stock market is getting affected? This is true. But we small retail investors do not affect the stock market. We are too small individually. Do you want to know who really moves the market? They are institutional investors, the mutual funds, the pension funds, insurance companies, sovereign wealth funds, FIIs, etc. These institutions manage tens of thousands of crores of rupees. They have investment mandates that are benchmarked against a specific risk-free rate. When US bond yields rise even by 0.25%, these institutions recalculate their asset allocation models. In a rising interest rate scenario, they move some money out of equities into bonds. And when large institutions move money, stock markets also move. Even a 0.25% rise in bond yield can trigger selling worth thousands of crores in the equity market. This is why you will notice that every time the US Federal Reserve hints at raising rates, Indian stock markets fall. It is not just sentiment or panic, there is a connection, and now you know about it. Now let's step back and try to see the full cycle. It starts with gold. For centuries, currencies had value because they were backed by gold. Then after the Second World War, the dollar replaced the gold as the world's reserve currency under the Bretton Woods Agreement. In 1971, the dollar itself lost its gold backing and became a fiat currency. But the dollar remained dominant because of the petrodollar and because of the deep network effect. Because the dollar is the world's reserve currency, the US has a unique privilege of being able to borrow heavily, running a fiscal deficit of around 6% of GDP without devaluing its US dollar. The US borrows money to make up for the fiscal deficit by issuing treasury bonds. The interest rates on these bonds is the world's risk-free rate. When inflation rises in the economy, the US Federal Reserve raises interest rates to control it. When interest rates rise, newly issued bonds offer higher higher yields. Raising bond yields means risk-free rate has gone up. Institutional investors now recalculate. They reduce their equity allocation by selling stocks in say emerging markets like India and China. As a result, stock price falls in India. So you can see how eventually everything that is happening in the US shows up in our stock prices. So what is the practical takeaway from all of this? The first thing to understand is this. The stock market does not exist in isolation. What we see in our trading screens is the outcome of thousands of different things happening around the world. A decision taken in a meeting room at the US Federal Reserve in Washington directly affects the Nifty and Sensex in India. The second thing is we must learn to watch the right signals. We do not need to become a macroeconomist, but a few things are worth tracking. What is the US Federal Reserve doing with the interest rate? Are the US 10-year Treasury yields rising or falling? What is the inflation trend in the US and in India? These are not difficult things to track, and by tracking it, you can actually foresee when the stock market is going to change its course. Thank you for watching. I will see you in the next one.